The U.S. economy, long seen as a pillar of stability, is showing signs of strain, with rising debt, market volatility, and trade policies fueling concerns about its long-term health. On April 2nd, President Donald Trump unveiled sweeping new tariffs, triggering a sharp sell-off in stocks and bonds. The S&P 500 saw its worst single-day drop since 2020, while Treasury yields spiked in a rare simultaneous sell-off, a pattern more common in emerging markets than in the United States. Typically, investors fleeing stocks seek safety in bonds, but this time, both markets fell together, signaling deeper unease.
Typically, that is the closest thing we have to a safe haven.
Investors talk of a fire sale in the bond market.
By April 4th, Treasury yields were rising at one of the fastest weekly paces in over 2 decades.
Honestly, bond yields, they moved around like a stock.
Ajay Rajat-Yaksha, global chairman of research at Barclays, warns that surging long-term yields pose a major risk to U.S. equities. Higher borrowing costs could squeeze businesses, dampen hiring, and push mortgage rates upward, further straining an already cooling housing market.
In which there's a building up of debt in a cyclical way that becomes too large, and we're going to have problems. We're going to have a government debt problem. Maybe we can get into this.
U.S. Treasury Secretary Scott Bessent has acknowledged the pressure to keep yields in check, as the federal government now spends over 3% of GDP just on interest payments, a burden worsened by the Fed's inflation-fighting rate hikes. President Trump's tariffs, which risk reigniting inflation, make near-term rate cuts unlikely, locking in high debt servicing costs. This may explain why Trump has publicly lashed out at Federal Reserve Chair Jerome Powell, demanding immediate rate cuts and undermining the central bank's traditional independence.
If I want him out, he'll be out of there real fast, believe me.
So why are Treasury yields rising? There's too much debt and too few buyers. The root of the problem lies in a growing imbalance, an oversupply of U.S. debt and weakening demand from traditional buyers.
There's too much supply and demand and so on, and we have a monetary inflation. We will have great disruptions, and that could be like the breakdown of the monetary system in 71. It could be like 2008. It's going to be very severe. I think it could be more severe than those.
The Treasury market has ballooned to $27 trillion, roughly the size of the entire U.S. GDP, with issuance hitting record levels in recent years. Meanwhile, foreign governments, which hold about 30% of outstanding treasuries, are pulling back. Japan, the largest foreign creditor, sold over $20 billion in international bonds in early April as Trump's tariffs rattled markets. Japan's foreign minister even floated the idea of using treasury holdings as leverage in trade talks, a sign of eroding confidence in Washington's fiscal stewardship. Compounding the issue, nearly $7 trillion in U.S. debt will mature in 2025, forcing the government to refinance at higher rates. When bond supply outstrips demand, prices fall and yields rise, creating a self-reinforcing cycle that could slow economic growth and intensify fiscal pressure. As Bloomberg noted, global investors are finding there are credible alternatives to U.S. bonds. One such alternative is gold, which has soared past $3,000 an ounce as central banks and institutional buyers diversify away from dollar-denominated assets. While the U.S. financial system remains the world's most dominant, recent turbulence suggests that unchecked deficits, political interference in monetary policy, and aggressive trade measures could gradually undermine its standing. The road ahead will depend on whether Washington can restore fiscal discipline or if the markets will force its hand.